Welcome to a video that I like to call the Deep Dive video. Each week I post daily videos as well as weekly videos and an intermarket analysis video. In those videos, I don't use every chart that I look at each day. So this video is designed to look at the rest of the charts to give us some insight as to what's happening in the market. This is being prepared for Monday, March 13th. The first chart is a chart that I started using a while back, but I'm just showing it now in the videos. I'm trying to get an idea of what is the range of the VIX. We go through times when the range can be quite a bit higher, such as in 2008 to 2009, where we had a range of about 40 on the upside and 20 on the downside. Then from about 2013 up to the COVID plunge, we had a range of about 20 to 12 or so, and that's usually the normal range. After the COVID plunge, we've gone back to a higher range with about 28 or so on the upside and 20 on the downside. And over on the right-hand side, we're currently at 22.91 or almost 23. And this gives us an idea of how to interpret the VIX at different times. The idea is when the VIX is high, it's time to buy. Well, what is high? There's absolute numbers that are above 20. Well, this tries to give us some relative numbers based on what's happening in the market. And then when it's low, it's time to go. Sometimes this can shift over a period of time. Another thing that's interesting is how far are we from the all-time high? As of Friday's close on March 10th, we are down 19.86%. Over on the right-hand side, there's the red line showing the current close. This is another new chart that I haven't shown in any videos. We're getting CPI in the upcoming week, and that's really what the market's hanging on because it feeds into this inflation and interest rate scenario. On the top, we have the CPI, which is seasonally adjusted, and then the indicators down below show the rate of change 12 months. So are we growing or not growing? And we can see through a lot of 2021, inflation was ticking up, and then it topped out in about June of 2022 and has since been coming back down. So this gives us an overall trend. And then on the very bottom, we have a rate of change going back just 1 month on a month-over-month basis because that's what the market likes to use to analyze what's happening. We also have the core CPI, which is when you take out food and energy. It continues to go up on the top. And you can see the rate of change going back 12 months. It had been going up, seems to be topping out, and is now starting to come back down. And then on the bottom, we have the 1 month rate of change. Looking at the technical alerts, this is just for Friday's session, and we had a pretty significant down day, so all of these are red. And we read this by looking at the bottom and going to the top. Now, this list is freely available at stockcharts.com if you want to follow this on a day in and day out basis. I do. I have it on my homepage or dashboard for stock charts. It not only gives information about the S&P 500, it looks at all the other major indexes as well as sectors. Where on Friday, we dropped below 3,900 with the S&P 500. That's really the only alert. The other alerts were from the NASDAQ going down. We had some NYSE bullish percent index. It crossed below 50. The tech sector was also dropping, as was the financial sector, in the wake of the Silicon Valley Bank being taken over by the FDIC, and a number of different sectors had also switched more negative. So this gives us an idea on a broader scale. Are things looking more positive or are they turning more negative? Another thing that's freely available at stockcharts.com is what's called a scooter score. This is taking a non-biased mechanical approach using technical analysis and coming up with a score for the 5 indexes that I track the most. Coming in first this week is the Dow, and that is represented by the ETF, the Diamonds, and it's coming in with a score of 48.9, and that's the highest score this week. In second place is the Qs at 41.3, where the Qs had been in last place for quite a while. Well, now they're bumping up as the NASDAQ 100 and the Dow, or blue chip stocks, bigger companies that are more established, they seem to be holding up better right now than some of the smaller stocks. Then in third place are the mid caps, which got really hit this past week. They come in at 37.5. Small caps, which had been in first place with mid caps going back and forth, this comes in at 35.7. And then we have the S&P coming in at 33.7, currently in last place. So what we're seeing from this is that the bigger companies are holding up and some of the tech companies are holding up, where the small to mid-cap stocks are seeing some weakness. One of our short-term indicators includes the moving average rainbow. Looks kind of cool, but we're just dancing all around here. The moving averages that are plotted on this chart start with a 10-period moving average and go all the way up to a 50-period moving average. Then some other indicators. Here's standard deviation. When we're above this moving average, we're above the standard price or the average price. When we drop below it, that means we're below the average price. Well, we're not too far underneath the moving average currently. The mass index is not generating a signal right now. When we pay attention to this is when it crosses above the red dashed line and then eventually above the blue line. And when it comes back down and crosses the red dashed line again, that is a signal that some kind of change in trend is on the way. We don't get a lot of signals from this, but when we do, we evaluate the market at that time to say, okay, we've been going up. The mass index just generated a signal. Now we might be getting ready to go down. And then the inverse of that is also true. Praying bottom fisher, when this crosses above the red moving average line, that's generating a signal. So right now we're not getting a signal. The Conners RSI works the same as the RSI, where we look for extreme positive or negative readings. We are negative since we're below the dashed line, but we're not getting an extreme reading currently. Here's an intermediate term rainbow going from a 50 period moving average all the way up to a 100 period moving average, and shows how we're dropping below as things have turned more negative. This is a vortex indicator. The green line measures buying and the red line measures selling. Well, the red line is on top and advancing, so that is negative. Ease of movement, this is what is the path of least resistance for stocks. When we're below the dashed line and declining, that means the path of least resistance is down, and then the inverse of that is also true. We drop below the zero line and we are declining as stocks continue to decline, and this just confirms the downward movement. The money flow index is an oscillator where we look for extreme positive or negative readings. We also use this when it's above 50 and advancing, that's positive. When it's below 50 and declining, that's negative. And currently we are below 50 and declining. The Sean trend meter, after getting extreme positive, has been falling back, and we're more in this neutral area now. But this indicator is pointed down, so that is more negative. When we get down to this pink area, that's when we are oversold on an intermediate term basis. The boom indicator measures how far our price is away from the 50 period moving average on the top, and the 200 period moving average, that's on the bottom. When we're above zero and advancing, that's positive. Well, now we're below zero and declining, both with the 50 period moving average and with the 200 period moving average. RSI, when we're below 50 and declining, that's negative, and that's what we're seeing with the RSI 14. The RSI 9 is also negative and starting to get a little bit extreme negative, but just barely entering extreme negative territory. Copic curve looked like it was generating a signal, and I brought this up in one of the daily videos, but we're now turning back down as the market's been experiencing some weakness. This chart just measures, are we above or below the 200-day simple moving average? We had been above it for a lot of 2023. Well, now we've dropped below the 200-day simple moving average. This is an out-of-the-box trading system called the CMB Composite Index. When we're coming down and we cross the first line, which is green here, we do have a sell signal that's been confirmed as the composite index continues to decline, so that is negative. How I use this is more like an oscillator, where we look for extreme positive or negative readings, and we're not seeing that right now. Ultimate oscillator, just like the other oscillators, below 50 and declining and not extreme. PMO study shows the PMO is in a decline. Also, based on price and volume, we continue to decline. We did get below the 100 period moving average as we then dropped below the 200 period moving average. This just shows how support has been lost in the past week. This next chart shows the 20 period simple moving average, and that's short term, of the open, high, low, and close. It was interesting that a few days ago when we were going up, we hit the upper band of this high moving average, and then that acted as resistance, and then we've been falling back down ever since. We're not near any of the lines right now, so that's why I have not been showing that. This is a chart that I don't show all that often. This is the S&P 500, which is a weighted index, and then takes a ratio comparing it to the equal weight S&P 500, where every stock is treated the same. We're seeing a little bit of a breakout as the weighted index is starting to outperform the equal weight index. And that's also going into the scenario that the big companies that make up most of the S&P 500, they're outperforming all of the other stocks currently, and that could provide a positive backdrop for the S&P. Its growth stocks, when they're going up, that's how the S&P 500 benefits from going higher. Some long-term charts. Here's a 50 period moving average all the way up to 250 periods, and we plot a rainbow on here. It's kind of a jumbled mess currently. We were showing a lot of improvement, but since we've been falling back down, these lines are starting to cross over each other. Special K is a very long-term oscillator to denote either an uptrend or a downtrend. It looked like we were getting ready to cross over this red line, but then we turned back down and we're still below a declining moving average. So this long-term trend is still negative and has been negative since early 2022. This is a long-term moving average study. I keep the 50-period simple moving average on the top just as more of a reference point, and it's starting to get rather extreme negative. This chart is also looking at the 150 and the 200-day simple moving averages, where they're both declining and not giving us an extreme negative reading. Some other measurements. This is the Vixen, or this is the VIX for the NASDAQ 100. I can't really use this chart all that much because of a lot of erroneous data. So I look down here at the line chart showing how the volatility in the S&P picked up. Well, it also picked up in the NASDAQ 100. This is a Fibonacci measurement going from the all-time high to the October lows, how we came right up to this 38.2% retracement and have been falling back down ever since. Some rate of change charts. I use them anywhere from 1 period all the way up to 250 periods. This one I like to show because it gives a longer term look at the market, where we set a double bottom back in 2022 and have been trying to bounce back up. And here's another look at that same chart going all the way back to 1980, where it is showing some improvement, even though we're seeing short to intermediate term weakness currently. Then an update of some of our possible positive scenarios. The stocks in the S&P 500 that are above their 200-day simple moving average are starting to deteriorate after not giving us an extreme positive reading. We're still working off of this loosely defined extreme negative reading, where a lot of times when we get down to this level and then reverse, that gives really good support to the S&P. We're just kind of floundering around now with this indicator as stocks are chopping. Another thing to look at is the 10-day average of the S&P 500 highs minus the lows. We're dropping below 50 and declining, so that is more negative after giving us an extreme positive reading. The equity put call ratio. I like to use this in the daily videos, but the data for this is sometimes very delayed. When a lot of puts are being purchased, this put call ratio will go up. If there are a lot of calls being purchased, this ratio will go down. And with Thursday and Friday's move, we saw a real spike up in the equity put call ratio. Then we look at a 5-period simple moving average of that same chart, showing that this is also going up. And then longer term, we're getting up to that 0.8 level where we often get extreme negative readings. Since we've been falling lately, and since this has been spiking, if we see some kind of a bounce, then we would start to see this indicator go down, and a lot of times that gives real good support to the S&P 500. This is a 253 simple moving average of the equity put call ratio. When it's going up overall, that means fear is increasing. It looked like we were starting to turn down, but then with the recent weakness, we started to go back up. This is another relationship that we look at, the VIX, and a correlation with the S&P 500. Not really telling us anything right now. We really pay attention to this when we get above this dashed line, because that means the VIX is acting weird and stocks may be getting to reverse. I hope you found this helpful. Please feel free to check out the daily videos that I post, as well as the weekly video and the intermarket analysis video. After this video, I will be preparing a supplemental video where I look at charts outside of the charts that I create and that I show every day to try to gain some insight and information about what is happening in the market. So I will talk to you in the next video.